capital asset pricing model, CAPM. Very popular model, CAPM, and very good model. Relatively actually a better model than the dividend model because this model considers the risk that is involved in the investment. In fact, it's a model that kind of calculates the return required on shares. That's the way it looks at it because this is directly looking at shares and asking what kind of return would the shareholder be expecting from this particular share. And this has a lot to do with risk. It takes into consideration the risk, yeah, involved in share investment. You can see that the dividend model that we just looked at, there's nothing in that formula that considers risk. It's strictly looking at dividend and looking at maybe growth rate and the price of the share. Yeah. But not anything explicitly looking at the risk the shareholder is taking by investing in those companies. But that is an improvement that capital asset pricing model is bringing and saying that you need to consider the risk and return because they are directly proportional. So when you take high risk, you should get high return. And that is why the CAPM formula says that the cost of equity, remember, which is the same thing as the rate of return required by the investors, is equals to the risk-free rate return plus beta into bracket market return minus risk-free rate. And I will explain each of these terminologies. So this is the capital asset pricing model formula, which we'll be using to calculate the cost of equity. KE is cost of equity, which you are very familiar with. So KE is the cost of equity. RF is the risk-free rate return. Risk-free rate, because I will explain what that means. So risk-free return rate. What this is saying is that there are some instruments that are deemed to be free of risk. Take, for instance, government bonds, treasury bonds. Yeah. Naturally, yeah, you can say ideal world, yeah, there is nothing that is 100% free of risk. But in finance space, we acknowledge that some investment are free of defaults. They are not likely to go bankrupt or unable to repay their debt. So if government is selling bonds to you, definitely they will pay you back. It's very unlikely that that government will run away or will not be or will go bankrupt and will not be able to pay back. So the assumption is that they are usually risk free. So there is no risk associated to those investments when you put your money on them. So in that case, you expect that the return on those instruments will be low because there's no risk. So return is low. And such return is called the RF, is the risk-free rate return. And that is what we are talking about here. So that is the minimum any investor should get. So that's the starting point for capital asset pricing model. It's saying that the minimum return you should get as an investor is this risk-free rate return. But if you are now putting your money in shares of a company, then you must be getting more than someone that is putting money in government bonds. And that is this other part, the additional benefit you should be getting by putting money in shares because shares are not risk free. So, which means on top of the small return that you are get that people that put money in government bonds are getting, RF, you should be getting more than that. And the more that you'll be getting is this beta times RM minus RF, which I'm going to explain each time to you. I'll come to beta last. RM, what is RM? RM is a market return. So that is the general market return. That is the market return. So which means on the average, this is what the market is given to any investor. So you usually have a basket of shares that are in index funds or maybe S&P 500 for example. Usually that is what the market is doing. So a particular company might be doing more than the market or less than the market. It depends. But there is a general rate of return on the market that is almost kind of guaranteed relatively, right? And that is the RM. And I already told you what RF is. So which means RM minus RF is actually what we call the market premium. It's a premium because this is saying that the extra you will get by investing in the market. So when take for instance, if RF is doing 5% and market is doing 8%, then you are saying that anybody that invests in the market get extra premium of 3%. So if you invest in market, you get extra 3%. So because you'll be getting 8% against 5% if you have invested only in a risk-free instrument, government instrument. So you get extra 3%. Extra 3%. And that is called the market premium. Now, we are not looking at investment in market here. We are looking at investment in shares of a company. And that is where beta now comes in. Because we need to adjust this market premium to company's premium. So to get the premium, extra premium you will get as an investor, extra premium from investing in company, say in company A, then that will be beta of company A multiplied by the market premium. So beta of company A multiplied by market premium. You can see that company A will have a beta, which I'm going to explain, and company A will have extra premium of beta multiplied by the market premium in order to get its its extra premium the investors are asking for by investing in such a company, right? So now going back to this formula, RF is the minimum anybody should get by investing. But if they invest beyond risk-free instrument, which means they are investing in company A shares, which is not risk-free, then they should be getting the risk-free plus additional premium. And the additional premium is the beta of company multiplied by the market premium. And what is beta? Now let's talk about beta. Beta is just the measure of volatility of share price. Of share price. Measure of volatility of share price. Right? So what's volatility? Volatility is just how the share price of a company, how fast is it changing? Sometimes you see, if you look at internet and look at, let's say these are the dates and this is the price. You see price of company just going like this. Some can just be like this. Some can just be like this. Some can be like this. This is the most volatile out of all of them. That's what volatility is talking about. How fast the share price is changing. This is least volatile, almost constant. This is very less volatile as well. And this is also less volatile, just changing once in a while. So volatility is about the speed of change of share price, right? So high volatility means high risk. So high volatility is the same thing as high risk. And in that case, you expect the premium to be high. And most importantly, please note that the beta of market is always equals to 1. So the volatility of share of company is usually measured relative to the market. So when you compare this to the market, how fast is that share price changing? Because beta of market is always, let me write in capital letter. Please take note, always equals to 1. Now, what does it mean? Because you can also be asked in exams to say, interpret, if company A has beta of 0.5, what does it mean? And they will give you in MCQ different options. You can say anything, but take note. What this means is that because this is positive, because 0.5 is a positive figure, and you already know that beta of a market will always be positive 1. So the sign shows the direction. So which means the share price of company A is moving in the same direction as the market, right? That's what it means. It's moving in the same direction because it's the same sign, the same direction as the market. But guess what? Because it's 0.5, our market is always 1. Then, however, it's moving at half the rate of market change. So it's not moving at the same speed, at the same way the market is changing, but half. So it's half slow or half fast as the market is moving. So it's not moving, it's not changing at the same rate. If market is changing at 10%, company will change at 5%. That's what it means. If market is changing at 15%, company will change at 7%, 7.5%, half, right? But if the beta of a company, yeah, is negative 0.5, it means that it's moving in the opposite direction. Please take note. Yeah, and half. So opposite direction, and the amount is half as fast. Yeah. So which means if market changes by say 6%, yeah, if market changes by 6%, then this company would change. So if say market increase by, because it's positive 6%, right? So it means the return on market has gone up by 6%. This company's return will not go up by 6% because it's negative beta. It will go in the opposite direction. Market is always positive 1. Nothing can change that. So if your company has a beta of minus 0.5, then that means this company will go down for sure. But is it going to be at 6%? No, because its volatility is half of the market, right? Then it will go down by 3%. And if beta of a company, another one just to be sure that you understand, if the beta of a company is 2, if market changes by negative 10%, then company, because company's beta is positive 2, yeah, this is an example. Let me use this as example 1, this is example 2, this is example 3 of interpreting beta. Market changes by minus 10%, company will change in the same direction because the company's beta is positive and market is always positive 1. So the company will also change. The company return, you also expect it to reduce. So it's going to be negative. And will it be at 10%? No, because it's twice as volatile as the market. Its beta is 2. So it's going to change by negative minus 20%. So which means it's going to reduce by minus 20%. So that's how to interpret beta. You can definitely be asked in exams a popular MCQ question. If you have any question, please put in a comment. Let me know. Something you must understand and be very comfortable with. Right. Yeah. So let's just look at one example for capital asset pricing model. Yeah. And that is, let's say like we have a company D. Yeah. Let's use a different letter this time around. The company D has a return. Yeah. Market return. Let me see. Let's start from this. So let's say the market return is equals to 15%. The beta of company D is equals to 1.2. And the risk-free rate return is equals to 8%. Calculate cost of capital. Yeah, you see, I've not said calculate cost of equity or calculate cost of debt, but if this is the only information I've given you, the only thing you can calculate here is cost of equity, because we're only talking of beta RA, because sometimes the information available will also tell you what you're supposed to calculate. So cost of equity here has to be capital asset pricing model, because I've not given you any information on dividend. So cost of equity is equals to RF plus beta into RM minus RF. And that means cost of equity is equals to 8% plus 1.2 into bracket RM, which is 15%, minus 8% risk-free rate return. And that will give you what now? That's 8% plus 1.2 into 7%. And if you put that into calculator, that should give 16.4% as K. And so that's where using capital asset pricing model, that's where it's been applied. Sometimes they might not give you market return, but they give you market premium of 7%. You can see you don't need to do all of this again. Once you have a market premium, then you just go straight to 7% and you apply it like that. But you said capital asset pricing model is relatively better than dividend model because it considers risk, but that doesn't mean that it doesn't have its shortcomings. So let's look at its criticism. Yeah, some people still believe that it has its own shortcomings. Yeah, and the first one is the fact that it does not consider transaction cost. You can be asked after you have been asked to calculate the CAPM. Yeah, the typical question will be to criticize the model. So please learn the model and the criticism. So does not consider transaction cost. That's number one. The number two is the fact that beta only use historical data. Yeah, which is the reality. Before to establish to determine or estimate your data, your beta, usually you need to collect a lot of historical share price of that company and compare with the market and all of that. So it's a shortcoming because things could have changed and might not really reflect the reality. So that's a shortcoming. The third one is that it only considers, so it considers risk, but it only considers systematic risk. And you might be wondering, what is systematic risk? Let me quickly tell you what this is. So there are two types of risk really in the share space. You have systematic risk and what we call the unsystematic risk. This is the risk of general market. So risk of market in general is not specific to company. So this is risk of market in general. But this is risk specific to company. Please take note. This is specific to a company. So which means You cannot avoid this risk, and that is why CAPM thinks investors should be compensated for it because it's outside their control, so cannot be avoided. But this one can be avoided by diversification. So those are the two major differences. So example of this is maybe like a recession. If there's recession, everybody will be impacted. It's not just about a company. The whole market will be impacted. Yeah. But you can have business risk or industry sector risk. Yeah. That is specific to a particular company. It's not a particular industry. It's not. So if you want to avoid that kind of risk, you can buy shares in different industry. You can buy in technology, buy in financial industry, buy in manufacturing, so that if one is losing, another one is gaining, and you can balance your risk like that, right? So, but what CAPM is talking about is just systematic risk, and that is the beta. That's what beta is actually measuring. Right, the beta that we have been talking about. Because it assumes that you, as an investor, should take care of your unsystematic risk. And how do you take care of it? By diversification. So, because of that, you are not expected to be compensated for taking such risk. So, when it is talking about risk and reward, the type of risk that it's talking about is only systematic risk. And that is why this is being seen as a shortcoming, because the popular opinion is that no matter how much you diversify, you can never eliminate all your unsystematic risk. So there will still be some bits and pieces of unsystematic risk in your portfolio, and that is a shortcoming. Yeah, so that is it for cost of equity. The next video will look at cost of debt. And remember, if you enjoy this, please like it, put a comment, subscribe, share, and let me know if any suggestions you also have. Until then, see you again. Bye.